Welcome to Talk Tickers. We're your go-to for getting up to speed on the latest earnings calls.
That's right. We take all the key numbers, the management chat, the strategy updates, and we break it all down for you.
So you can quickly get a handle on what's really driving these businesses.
And today we are doing a deep dive into Flywire Corporation, specifically their recent Q1 2025 earnings call.
We'll hit the key results, unpack the strategy and market talk, and look at their outlook. Let's jump in.
Okay, so starting with that Q1 snapshot. Revenue less ancillary services came in at $128.7 million.
And that's up 16.8% year over year, right?
Yeah, or even better, 18.6% if you look at FX neutral. And importantly, that was above the high end of their guidance range.
Right. Okay. Any particular reason why?
They pointed to outperformance in travel, which maybe isn't too surprising, but also Australian education. That was a key driver for the beat.
Interesting. And looking at the revenue types.
Transaction revenue, that grew 14%. But the platform and other revenue line, that jumped 35% year over year.
Wow, 35%.
Yeah.
That really tells you something about where the growth is accelerating.
Definitely. Moving down the P&L, adjusted gross profit hit $82.5 million. That's up 14.6%.
Okay. And adjusted EBITDA.
$21.6 million. Also solid, above the midpoint of their guidance.
And they're making progress on the bottom line too, right? GAAP net loss.
Yeah, it improved compared to last year. Came in at a loss of $4.2 million for the quarter.
Got it. And one more thing from the snapshot, they were buying back stock.
They were. Repurchased about 3.6 million shares in Q1, spent roughly $49 million doing that.
Okay, so that covers the main numbers. Let's get into the strategy and what management was saying about the bigger picture.
Right. They definitely acknowledge the macro environment is, challenging. Economic uncertainty, policy stuff happening globally.
But they didn't sound worried.
No, not really. The tone was quite confident, actually. Focus on their own performance and the future. Things they can control, like innovation, client value, executing their plans.
Almost framing the headwinds as a chance to get stronger.
Exactly. Using the pressure to, optimize and maybe even gain an advantage, like clients focusing more on ROI or looking to consolidate vendors. They see that as an opportunity.
And it seems to be working. Based on client wins.
Looks like it. Signing 200 new clients in Q1 is pretty good going. Plus, they mentioned a strong pipeline and really low churn rates.
Which they probably see as proof their model works, being embedded with clients.
Yeah, they really leaned into that. This idea that their resilience comes from that unique platform. It's not just payments. It's the specialized vertical software on top of their own global payment network.
Right. That combination allows for deeper integrations, single source solutions, daily settlement, things maybe a standard processor can't easily offer.
Precisely, and they think that really differentiates them, especially when clients are scrutinizing costs and looking for efficiency.
And they're still bullish long term, especially on core areas like education.
Very much so. Even with all the noise around visas, they argue the fundamental drivers for international education are still there. People wanting global experience, skills gaps, competition for talent, even demographic shifts.
Those underlying trends don't just disappear overnight.
That's their point. Now, they also updated on that operational review they announced last quarter.
Ah, yes, the efficiency push.
Exactly. Streamlining the structure, taking out some management layers, consolidating reporting lines. They mentioned payments product, data analytics, IT, and strategy biz ops specifically.
All focused on optimizing where they put their resources and capital.
Yeah. And a concrete step was appointing a new chief payments officer. The goal there is to accelerate the payment strategy and get better technical alignment across all the verticals, basically centralizing the payment functions.
Makes sense. And they talked a lot about data and AI, didn't they?
They did,
Yeah.
Using data analytics and AI to build new payment rails, improve localization, expand domestic capabilities, and streamline internal stuff too, like client onboarding, support, KYC checks.
Seeing results already.
Apparently so. They mentioned launching enhanced recurring payments capabilities and improving the cost and speed of U.S. payments. Oh, and a new partnership in India for loan acceptance solutions. That sounds important for that market.
And on the cost side, OPEX discipline.
Yep. Investing in procurement, vendor management, looking at their global office footprint, refining pricing strategies, all the levers you'd expect.
Plus optimizing the team itself.
Right. Prioritizing resources, using tech for productivity, making sure investments align with value, measuring results, and aligning hiring and compensation with a high-performance culture.
It sounds like this all feeds into a bigger digital transformation effort.
It does. focused on data analytics and systems, investing heavily in data architecture to get structured data from everywhere into one place.
For real-time insights, predictive stuff, AI use cases.
Exactly, building that foundation to be faster, more accurate, and deploy AI effectively across the board. Plus, optimizing tools, consolidating vendors, automating processes like, they mentioned, client onboarding.
So the strategy is really about that deep integration, vertical software, modern payments, embedded right into client workflows.
That's the core idea. Solving complex problems, managing receivables, streamlining back office work, handling cross-border seamlessly, things that are hard for just a payment gateway.
And that drives the land and expand motion we keep hearing about.
Precisely. Get in with one solution, then expand to SFS, software, payables, whatever. Makes the client stickier, grows recurring revenue. It's central to how they think about growth.
Okay, let's pivot then. How are the specific verticals performing? Starting with education.
So they acknowledge the dynamic environment, right? Policies, macro pressures. But they stressed that Q1 results were strong despite those headwinds.
So how are they managing that?
A big part is leveraging their global footprint. They're not just focused on the US, UK, Canada, Australia, the big four.
Which is about 40% of the market, I recall.
Right. They're actively targeting and capturing student flows to and from other countries, too. They mentioned growth in places like Germany, France, Japan, Singapore.
The next 20 addressable markets they talked about.
Exactly, which represents, roughly another 40% of global students. They're already there, but aiming for deeper penetration.
And they gave examples, right? Like new deals in Mexico, France, Singapore.
Yeah. International, House Mexico, College to Paris, American University in Paris, East Asia Institute in Singapore. They stressed how being local helps win both domestic and cross-border business.
And using the platform to capture more of the student journey, not just the initial payment, like expanding StudyLink.
Right, their agent product. University of Niagara Falls in Canada, Birkbeck in the UK were recent examples. It helps capture opportunities even if overall numbers are shifting.
Now, UK education sounded like a real bright spot.
It really did. Remarkable momentum, they called it. Partly driven by launching their student financial software, SFS, there last year.
They signed more SFS deals.
4 new ones just in Q1, set to roll out in Q2. And a strong pipeline behind that. These deals cover a whole range of fees.
Any big names?
University of Greenwich was a key win, specifically because their integrated software covers domestic, cross-border, and collections. They're also expanding with Oxford and Cambridge, adding colleges, upselling payables, and refunds.
And the UK is now their biggest education market overall.
That's what they said. Pretty significant shift.
Okay, what about the US? Let's say more caution there.
Definitely more complex, they admitted. Visa issues, immigration policy talk, they're watching it closely. But importantly, their U.S. strategy isn't just about international students.
Right, focusing on software integrations for all students, domestic payments, tuition management, collections.
Exactly. So even if international numbers fluctuate, they believe they can still provide value and grow by helping universities digitize operations for everyone.
Is that broader strategy working?
Seems like it. They're capturing more payment flows and SFS adoption is accelerating. Q1 was apparently their best ever quarter for signed ARR from full suite SFS deals, 5 new ones, plus wins in collections and third-party invoicing.
And there's still room to grow with SFS in the US.
Huge potential. They estimate only about 10% of their existing US cross-border clients use their domestic SFS. So big land and expand opportunity right there.
Okay, quickly on Canada and Australia. Sounds like uncertainty there too.
Yeah, recent elections, policy changes impacting student flows, focuses on supporting clients through that. In Canada, they mentioned StudyLink adoption, helping diversify where students come from given lower India volumes.
And Australia.
More resilient than they expected, actually. They think they outperformed the market through client wins and product adoption. Names like Charles Sturt University, Federation University came up.
Favorable weighting to top universities helped.
Seems so. Universities filled H1 seats, but they are assuming some H2 adjustments due to potential visa caps in their guidance, so they factored that in.
Got it. Let's switch to travel. Sounds like they're trying to copy the education playbook there.
That's the idea. Strong momentum in customer acquisition and revenue. They keep highlighting their differentiated approach, the integrations, pricing, tailored solutions for travel needs.
Any specific Q1 client examples?
Hammond Group in Norway, a tour operator, like the booking system integration and multi-currency options. Ozen Reserve in the Maldives, luxury accommodation, came via referral for cost-effective solutions. They're seeing good traction in luxury boutique, generally 21 new clients there in Q1.
And the Certify acquisition is key to this.
Absolutely transformative is how they put it. Unlocking that luxury boutique hotel segment, letting them monetize payments tied to hotel workflows, they see potential for billions in incremental volume by upselling payments using Flywire's network.
So it adds reach and product depth.
Exactly. And Certify hit some milestones in Q1. A large U.S. hotel management company expanded Certifi Pay to 65 properties. They're also planning Certify's international expansion using Flywire's know-how. Integration is going well, apparently.
And interestingly, no major macro headwinds seen in travel yet.
Not that they're observing currently, no. And that combined travel business, including Certify, is now running over $100 million annually based on the last year. So it's becoming quite substantial.
Okay, briefly on B2B.
Seeing good progress there, too. Monetizing payment volume, cross-selling, clients adopting invoice to cash and embedded payments. That software plus payments value prop is resonating.
Any wins highlighted?
Yeah, Sojourn, a marketing tech company using their invoice software to get paid faster, reduce churn, automate reconciliation. They also mentioned 9-round kickboxing. Insurance for students, Ole life solving pain points around invoicing, cash application, FX, local payments, integration, chargebacks.
And lastly, healthcare, turning a corner.
That's the message. Preparing for strong growth, they said. Validated by a key deal win in Q1 and strong EHR integrations.
Why did they win that deal?
Because they offered a comprehensive solution, financing, patient engagement, and payments all integrated. That unique offering seems to be the differentiator, leading to an expanded pipeline and more demo requests.
Okay, that covers the verticals. Let's dive back into the financials and especially the guidance.
Sure. So we mentioned the Q1 revenue beat, driven by travel and Australian Ed.
Right, and the transaction revenue grew 14%, supported by 28% volume growth.
Yeah, strong volume in international ed and travel. But importantly, also strong domestic education volumes, especially UK and US. They see domestic as a big global opportunity. Cross-border spreads were stable.
And that huge 35% jump in platform and other revenues.
Mostly platform fees not tied to volume, plus contributions from the Certify and invoiced acquisitions and improvements in healthcare.
Adjusted gross margin dipped slightly, though.
By about 110 basis points. Mainly mixed, they said faster growth in travel, which has a different margin profile, plus some settlement loss impacts.
But adjusted EBITDA was strong, especially the core business.
Yeah, excluding Certify, core Flywire adjusted EBITDA margin was up almost 480 basis points year over year in Q1, showing good leverage from gross profit growth and tight expense control.
Which is the goal, right? Operating leverage.
Exactly. Non-GAAP OPEX planned to grow much slower than gross profit. Ex-Certify was actually down slightly year over year in Q1. G&A costs, in particular, decreased significantly as a percent of revenue and even in dollar terms.
And streamlining paying off.
Seems like it. They also expect stock-based comp as a percent of revenue to be lower for the full year 25, around 12-13%.
GAAP net loss improved, but still some one-offs.
Yeah, restructuring and acquisition costs still impacting GAAP. But they still expect slightly positive GAAP net income for the full year, excluding Certify integration costs.
And capital allocation still focused on buybacks.
Yeah, high free cash flow conversion, strong balance sheet allows it. They have $57 million left on the current buyback program.
Okay, guidance time. Sounds like limited visibility, but underlying confidence.
That's the gist. They know the global landscape is shifting, but they trust their portfolio, client retention, product market fit. They're investing in automation and product for scale, leaning into the downturn, as they put it.
But quite cautious on U.S. education.
Very. Pointing to China-U.S. tensions potentially hitting demand, they're watching data closely, especially for Q3 peak season, modeling low single-digit revenue growth for U.S. Ed for the full year 25.
That's a big drop from last year's 13%.
It is, and they're assuming F1 visas will be down slightly more than last year's roughly 10% decline.
They put some context around that, though, didn't they?
Yeah, reminding people only some volume is first-year students. China, India are less than half their cross-border revenue, and tuition payments get split over time, so it's not an immediate cliff edge.
But despite that U.S. caution, they maintained full-year revenue guidance overall.
Correct. FXN revenue less ancillary still guided 10-14% growth, excluding Certify, and 17-23% growth, including Certify.
And the assumptions baked into that.
U.S. Ed low single digits, Aus Canada Ed down high 20%, healthcare high single digits, and the rest of the business above the midpoint average.
Holding back on flowing through the travel beat.
Yeah, being prudent there, citing potential macro softening. Certify revenue estimated $40 million for the year, and about a 1% negative FX impact expected overall.
Full-year adjusted EBITDA guidance also maintained.
Reflects the operational efficiency drive. Core margin expansion guide is unchanged. Including Certify, it implies 100 to 300 basis points of margin expansion for the full year.
How are they managing that with slower OPEX growth?
They plan to reinvest some savings from restructuring back into growth areas like data analytics, maybe some selective hiring later in the year, data permitting, gives them confidence they can hit margin targets even if things get tougher.
Okay, and Q2 specific guidance.
Tougher comparisons than Q1. FXN revenue growth ex Certify guided 7-11%. Including Certify's estimated $10-12 million, total FXN growth is 17-23% year over year.
FX impact in Q2.
Basically none expected based on current rates. Adjusted margins should still expand year over year, just maybe a bit slower than Q1. They guided 150 to 350 basis points improvement.
Did the Q&A add much more color?
A few useful points. They explain the H2 revenue acceleration expects Canada timing shifts, easier comps, and ramps from SFS, B2B, healthcare clients.
And universities aren't pulling back demand fundamentally.
No, they reiterated that universities still need the software solutions. Confirmed UK is the biggest ed market now. Clarified travel implementations are fast weeks.
What about NRR headwinds?
Driven by Canada, Australia mostly. Excluding those, NRR would be higher in the historical range. New products and domestic adoption should help build that NRR algorithm over time.
And healthcare really turning a corner due to that integrated solution.
That was the message. The combined financing, engagement, payments piece is key. Also clarified the next 20 markets are existing markets for deeper penetration, not totally new ones. And a travel GP chart dip was just COVID timing.
Okay, so summing it up for an investor. Resilience, strategic execution in a choppy market. Diversification is key. Operational review showing results. Software investments driving land and expand. Capital return ongoing. Cautious guidance where needed, but confident overall.
That seems like a fair summary of their narrative.
Right. Which brings us to our This Is Not Financial Advice segment. And let me be crystal clear. This is purely for entertainment and informational purposes, based only on our interpretation of the call. Do not trade based on this.
Absolutely. We are not financial advisors. Please consult with one before making any investment decisions. This is just a thought experiment.
Okay, disclaimer done. So, inspired by the call, the caution around U.S. international ed versus the momentum elsewhere, travel, UK ed, B2B, healthcare.
You could construct, hypothetically, an outrageous but plausible trade idea.
The idea, a pair trade. Go long Flywire, betting on that diversification and the operational improvements kicking in.
And pair it with a short position.
Maybe. Short an index, or perhaps a specific company you identify as being much more heavily reliant on just U.S. international student flows, maybe lacking Flywire's software depth or geographic spread?
The thesis being, Flywire's diversified engines might let it outperform something more narrowly focused on that pressured U.S. segment, potentially creating a spread, even if the macro stays tricky. Theoretically. Again, just an idea sparked by the call's themes. Purely illustrative, definitely not advice.
Definitely not advice.
Okay, so wrapping this step dive up. Flywire showed a strong Q1 beat. They're navigating macro challenges with stated confidence, focusing on efficiency and growth drivers outside the main headwinds. Travel, UK ed, B2B, healthcare showing momentum, capital going back to shareholders while investing in growth.
Guidance reflects some specific caution, but overall belief in the model and their ability to manage margins. And remember, this is all just based on what they shared on the earnings call.
So here's a final thought for you to chew on. How different is Flywire's strategy building that deep vertical software first, then embedding payments compared to a standard payment processor's model? Could that specialized integrated approach actually create a more resilient business, especially when global conditions are so uncertain and fragmented like they are now?
And maybe think about what other industries could benefit from that kind of deep, specialized, integrated approach.
Something to ponder. Thanks for tuning into this Talk Tickers Deep Dive. Yeah, thanks for listening. If you have any thoughts on this, let us know.